What's up everybody? Welcome to the Stocks channel. My name is Corey and today in the stock market we continue to battle the bear at very critical resistance, and so far the bulls are hanging in there. First up, let's take a look at the S&P 500 SPY ETF. So let's crack open this chart and see what's going on in the stock market today. Alright, so today in SPY we went absolutely nowhere, only going down 0.07% after we did slam into that very critical resistance around 416, and we are getting very close to battling the bear in SPY. The bear in SPY is likely here at 416 and SPY 421, so you will want to be very careful and watch price action very closely at this critical resistance. Now you'll notice volume is drying up, so we're not seeing any high convictions here, which I completely respect because as a bull I would not be comfortable buying this close to resistance, and as a bear you have been burned many times during this rally, so nobody is jumping up ready to short after being burned after such a strong impulsive rally. So for that reason you are going to see consolidation here as the market tries to decide if it wants to push higher or if it's going to try to be bearish yet again, even though the bears have been burned many times. If you're sitting there wondering when the stock market is ever going to go down again, the stock market is going to go down once you give up on shorting this market. No, but seriously, I'm serious. The market is extremely brutal and it does not want to go down while everybody is bearish, and yes, everybody is still bearish. With retail sentiment this bearish and retail thinking this is just a bear market and you simply just need to short it to make free money, the market is going to humble you very quickly. So I do believe it is very possible the market does go higher from here unless we start to see retail capitulating out of their short positions. So for that reason, I do not suggest being part of that crowd getting short squeezed, but I do also suggest being very cautious at this level. So what I'm trying to tell you is sometimes it's better to do absolutely nothing and just watch price action. The breakout above 416 will be very impulsive because it will trigger more short squeezing, and then if we get a breakout above SPY 421, we are likely going to short squeeze all the way back up to the SPY 433 or possibly higher. Now if we do not break above SPY 416, you are looking for a retest of very critical support down here at SPY 409. And the moment we break below SPY 409, I would instantly get more risk off. We have very critical support all the way down here at SPY 399, but the drop from 409 to 399 is not worth the risk. So if we break down below SPY 409, I would get risk off and wait for a retest of more critical support. So you really only have two critical levels to pay attention to, SPY 416 and SPY 409, and whichever level breaks first is going to tell you where the next leg in this market is going. It's that simple, so I'm not going to overcomplicate it. You are watching SPY 409 for critical support and SPY 416 for critical resistance. On the NASDAQ 100 triple Qs, we were up 0.47% as the triple Qs are completely ready to battle the bear, and we did get a close just above 324, but we are still below that resistance trend line that does define the bear market, which is right around triple Qs levels of 325 to 326. Now, as you can tell, the bear is right on top of price action, and the bear is ready to battle the bulls trying to break out above triple Qs levels of 325. So if the bulls successfully break that resistance, it is going to trigger a very impulsive short squeeze, and I will not rule it out as a possibility. It's very simple to be part of the crowd that's screaming the loudest, and the crowd is currently extremely bearish, so I would not be surprised in the slightest if we do short squeeze them out of their short positions, because as I said before, the market loves causing maximum pain to the retail crowd. The retail crowd is very cocky and very confident that they are going to be profitable on their short positions, so I will not be surprised if we squeeze them out of there and continue to see the triple Qs marching higher towards the 340s. Now you also have to be very cautious as a bull to not blindly buy at resistance, so I would wait for that breakout before buying back into the triple Qs. This is a great place to lock profits and watch price action. Critical risk on the triple Qs is all the way down here at 314. And as soon as we break down below that level, I would get a lot more risk off because we could be coming all the way back to the low 300s. So on the triple Qs, your risk reward is not that great for long positions, but I also do not suggest shorting a market that has a lot of retail bears in it because it is very likely going to continue to short squeeze. So critical levels on the triple Qs will be 324 to 326, and critical support will be down here at 314. In the Dow Jones, we were down 0.24%, and you can see the Dow Jones is definitely losing a lot of steam as it is struggling to break and close above 329. so it is going into somewhat of a consolidation and more than likely going to consolidate inside of a wedge. So for that reason, you're getting a lot more risk off in the Dow Jones if it breaks down below 324, and you will be looking for a retest of 320, and you're getting a lot more bullish above 329 for a retest of 333. Expect more sideways consolidation until one of those levels breaks down, and then you can know where the next leg in the Dow Jones is going to be. On the Russell 2000 IWM ETF, we were down 0.21%, and the Russell 2000 is very close to reaching the price target at 191, and our critical risk level is down here right around 187 to 188, so you will want to get a lot more risk off if we break below that level for a retest of 182.5. The short squeeze in the small caps will come on a breakout above 191 for a retest of all the way back up to the 200 simple moving average right around 200, so you're getting a lot more bullish if we break out above 191. On the ARKK ETF, we were up 0.82% as ARKK is closing on top of the upper Bollinger Band because we are now in short squeeze territory, with ARKK getting 2 consecutive closes above 47 and 2 consecutive closes above 49. This is short squeeze territory, and as you can tell, ARKK does have the full bull trend and it does have higher lows and higher highs. So whether you want to believe it or not, it does look like ARKK is out of the bear market. Now that is instantly going to change if it turns around and closes below 47, but while it is above 47 and above 49, you can stay bullish with those as your risk levels, with the upside price targets at 52 and 55. The VIX was down 2.28% today as the VIX is coming back down to retest the lows right around VIX levels of 21 to 20, and that is very likely going to be support for the VIX, but that doesn't mean the VIX can't crush down below it. If the VIX crushes down below 20, that is going to go hand in hand with a strong bull market. Even though we cannot assume it's going to happen, we are getting very close to seeing. The VIX is in a bear trend and it did fail to break above 24, so far the bulls still look like they're in full control. On Bitcoin, we are currently down 1.44%, and Bitcoin is breaking back down below the 20 simple moving average and getting very close to our critical risk levels of 21 to 22,000. I do believe Bitcoin is trying to make higher lows and higher highs, but we cannot rule out the possibility that it's coming down for a retest of 19,000, and you'll know it's going to retest 19,000 if it breaks down below 21,000. I would wait to get more bullish until we can close back over the 50 EMA, which is right around 23,300, or wait for the bullish breakout above the previous daily high at 24,000. This is not a very impulsive trend, but it is definitely a bull trend with higher lows and higher highs, so the next higher high should get things moving in Bitcoin. Woo, is it getting hot in here? You already know what time it is. It's time for hot stocks because the big tech names are absolutely ripping higher, and a lot of the big tech names are looking like they could be signaling that we're getting out of the bear market. And as you know, big tech stocks move the market, with all of these big tech names being the top 10 companies in SPY and the triple Qs. So first we'll look at Amazon, and as you can tell, Amazon has done very well since earnings after a very large gap up, and it didn't even close the gap, it just continued to run higher. And we did break above that very critical resistance at 138.7. As you can tell, Amazon also has the full bull trend, and it's getting very close to a very interesting resistance zone, which is going to be right around 144 and that 200 simple moving average at 146. So this is going to be a very critical test for Amazon. Critical support levels in Amazon are now going to be 138.7 and this previous daily low at 134. And if we break below those support zones, I would get very cautious because we do have a very large gap to the downside, which means Amazon could be coming all the way back down to about 125 to about 123. Now there will be very strong support because we do have the full bull trend, which means bulls will be confident buying the dip. But you will want to get cautious if we do break down below 134 because we could be coming all the way back down to the low 120s. Now, if we do get the bull breakout above 146, that is going to look like a very strong bullish breakout, which could be telling us that we are getting out of the bear market. And if I zoom out, you can see Amazon's resistance trend line is up there right around 152. So there is very critical resistance just above, but this is definitely a very bullish looking chart after what looked like a head and shoulders developing, and then we did get the bullish breakout, so this was definitely a bear trap in Amazon stock. So these higher lows and higher highs on a market moving name like Amazon are looking very promising, but you will want to watch that very critical resistance just above. On Microsoft stock, we were up 0.42% today, and Microsoft is breaking out currently because it did have a price target at 283, and we are starting to get the breakout above that level, with the next price target up here at 290, and then our 200 simple moving average at 295. Now, the interesting part about Microsoft stock is it did see high volume buying after earnings, and if I zoom out, you can see that we are breaking out of the resistance trend line, which does tell us that Microsoft stock could be telling us it's coming out of the bear market. With a big name like Apple and a big name like Microsoft breaking out and getting out of their bear markets, it is very likely we are going to get out of the bear market and spying the triple Qs as well. Remember, these are big tech companies with large market caps that move the entire market, and Microsoft stock is very close to having the full bull trend. Critical support levels in Microsoft will be down here at 278 and 274. And if we break below 274, just get a lot more cautious because we're more than likely coming back down to about 267. However, this is still a very strong bull trend of higher lows and higher highs with very impulsive bullish price action and a very important market moving name like Microsoft. So look for that next upside price target at 290 as long as we're above 283, and respect the fact that these big tech names are looking very bullish. On Nvidia stock, we were up 1.7% as we're getting very close to that next price target at 196, which I do believe will be very strong resistance, which means there is the possibility we get that right shoulder to form somewhat of an inverse head and shoulders around that neckline. But if we do get the bullish breakout above 196, you're looking for a quick trip up there to 213, and then we can start talking about the gap closes above. Critical support is still down here right around 181 and our 50 EMA at 175. So if we break below that critical support, look out below because we could come back down to 161 or fill the gap at 158. On Tesla stock, we were up 0.4% and Tesla got the second day in a row closing back over the 200 simple moving average. So I continue to tell you these big tech names look like they're breaking out of their bear markets, which is a very bullish signal for the entire stock market. Tesla 2 days back over $900 means that we are confirming that we do have another higher low, higher high, and the next price target is all the way up there at 970. Critical support will be right around 900 to about 911. So if we lose that support, you will want to be cautious of more downside because we could be coming back down to 864 or 839. But as you can tell, we have the full bull trend and we have very high volume bullish price action. On Apple stock, we were down 0.19% as Apple did fail to close above the price target at 166, but we are getting somewhat of consolidation and a doji around that level. If we get rejected from 166, it is possible that we come back down to 159 or retest the critical support at 157. But as long as we are above 157, you should be staying bullish on Apple. If we break below 157, we could be coming all the way back down to 151 or 150. So just be very cautious if we do lose support. The breakout above 166 will head us back up to our next price target to close the gap at 174. On the financial sector, we were down 0.33% and we're continuing to consolidate below the gap close of resistance while we are developing a bull trend. The industrials were up 0.37%, getting another daily closing high, pushing higher towards that 200 simple moving average. The healthcare sector was down 0.49%, closing back down below the 200 simple moving average, but still in the full bull trend and still getting ready to push higher from here. The energy sector was down 3.71%, closing back down below all the moving averages and getting very close to regaining the bear trend, so it's very likely trying to close the gap below at 69. So jumping back over to the S&P 500, this is extremely critical resistance, but do not forget what I told you about retail bears being way too confident and just piling into short positions, significantly increasing the probability that smart money wants to squeeze them out of their short positions. Remember, smart money moves the market, so follow the trend because smart money defines the trend. Your job is to follow the trend and manage risk. Don't bother trying to trade against the trend because while you can be profitable doing so, it is much more difficult to do, and why not make your life easier by trading with the direction of the trend? Always manage your risk no matter what you're doing, and do respect the fact that we are at very critical resistance, so there is going to be increasing probabilities that we are due for a pullback at any of these critical levels that I'm giving you. Also, don't forget that I do have Bank Trade Alerts, which is an algorithm-driven trade alert service that only trades the ETF TQQQ and sends you all of your buy and sell alerts directly via email and text message. Even in the bear market of 2008, Bank beat the market and had a very positive return. If you're looking for more information or want to subscribe, you can click on the link in the description of this video. I also have the Stocks Channel Discord where I do intraday updates and analysis and bring new trade ideas to you weekly. If you're interested in joining the Stocks Channel Trading Discord community, you can find out how to join the Discord server by clicking on the link below. So thank you for watching, everybody. I hope you're crushing this market, And as always, I will see you in the next episode.